Most Americans think housing affordability is about prices and interest rates. But there's a quieter force reshaping where people can live, and it doesn't show up on Zillow. Across the United States, homeowners are opening renewal letters and discovering something unexpected. Their insurance is gone, or it's doubled, or it excludes the very disasters they're most exposed to. In some cities, it's no longer the mortgage that breaks the budget. It's the insurance. And once insurance disappears, so does the market. What's happening now isn't loud. There's no crash headline, no emergency announcement. But city by city, this silent insurance crisis is deciding which places survive and which slowly empty out. For decades, insurance was the background noise of home ownership. You paid it, you forgot about it. But in the post-pandemic economy, insurers are recalculating risk in ways homeowners never had to think about before. Climate volatility, aging infrastructure, litigation costs, reinsurance pullbacks. At the same time, millions of Americans migrated towards Sunbelt states, coastal metros, and fire-prone regions, chasing affordability and lifestyle. Now, insurance companies are doing the opposite. They're retreating. And when insurance leaves, housing markets don't collapse overnight. They freeze, then slowly hollow out. Florida is the clearest warning sign. In many counties, insurers have exited entirely or imposed massive premium hikes. Some homeowners now pay more for insurance than property taxes. New buyers are discovering they can qualify for a mortgage, but not for coverage. Without insurance, lenders walk away. California follows closely. Wildfire exposure has turned entire zip codes into insurance dead zones. State-backed insurers are becoming insurers of last resort, often with limited coverage and higher deductibles. Homes still sell, but only to cash buyers willing to accept risk. Texas and Louisiana are next in line. Hurricanes, hailstorms, and flood claims have made insurers aggressive. Deductibles rise, coverage shrinks, premiums spike quietly year after year. Even inland cities are affected. In parts of the Midwest and Northeast, aging housing stock, sewer failures, and rising replacement costs are forcing insurers to reprice older homes, especially those owned outright by retirees. The result is the same everywhere. Homes become harder to insure, harder to finance, harder to sell. This isn't theoretical. When insurance premiums rise faster than wages or Social Security adjustments, affordability collapses without prices ever falling. Retirees on fixed incomes feel it first. So do long-term homeowners who paid off their mortgages years ago, only to discover they can no longer afford to stay. Local governments feel it next. As insured values drop, tax bases weaken, maintenance gets deferred, emergency services stretch thinner. What looks like a personal insurance problem quietly becomes a city-level decline problem, and most people don't connect the dots until they're already trapped. Looking ahead to 2026 and beyond, the risk isn't sudden collapse. It's selective abandonment. Entire neighborhoods that remain standing but slowly lose buyers, lenders, and services. Markets where prices appear stable, yet liquidity disappears. Insurance availability is becoming the new red line. Not interest rates, not prices. Whether a home can still be insured at all. This isn't a prediction. It's a pattern already forming. The insurance crisis won't announce itself. It won't trend on social media, and it won't hit everyone at once. But it is quietly reshaping where Americans can live and where they can't. And for many homeowners, the most expensive surprise isn't buying the house. It's discovering they can no longer afford to stay in it.